Okay, so we'll be proceeding from where we left off and talked about now majorly ALM, the strategies. We looked at the ALM strategy, asset liability management, the how to even hedge ourselves against the risk that arise from mismatches in our asset liabilities makes. And so now I want us to look at how some of the regulatory frameworks that are under regulatory requirements, for example, by a country's reserve bank or central bank or commercial banks, can affect the LM strategies that a commercial bank, for example, can put up in place. And yesterday we looked at some of the tools for example, for generally banks treasury management, okay, and the principles too. We looked at how, for example, the net stable funding ratios, the liquidity coverage ratios, and also to be able to diversify and forecast and maintain, do proper liquidity management, risk management, and also capital management. So, liquidity ratios, we are talking about the tools that, for example, the CBK and the regulatory frameworks and requirements that the CBK or the RMB, in this case, the Reserve Bank of Malawi, puts up in place for commercial banks, the liquidity ratio. So the liquidity ratio, or the liquidity coverage ratio rather, that, for example, the RMB imposes on commercial banks such as the National Bank of Malawi, the one that imposes also will impact on their ALM strategy, their asset and liabilities mix, because let's say for example, the Basel III framework that maintains that the CET1, the common equity one ratio of at least 4.5% of net assets. Okay, therefore, in that liquidity coverage ratio should be that you maintain a good capital buffers of high quality liquid assets such as cash and cash equivalents, cash reserves, and also treasury bills and treasury bonds that can easily be converted into cash and cash equivalents to enable the commercial bank to be able to meet its let me just close this and then I hope we don't we want
this you are inside.
we won't forget to unlock it.
Yeah.
Okay, so yes, so let's say the CBK imposes the Basel III framework that requires that you maintain at least 4.5% of your CET1. And then so now the liquidity coverage ratio, as we calculated the proportion of your high quality liquid assets that you have available, maybe over, let's say, a 30-day or 1 month period, over what you project or what you forecast to be the cash outflows, or what your customers will be needing to withdraw over, let's say, a 1 month period. And then that percentage, should the high quality liquid assets be more, and then that will also impact the ALM strategy, since the assets will be more than the liabilities, and therefore even your gaps, for example, the interest rate gaps and even the duration gaps will be favorable. But should it not be, should your, for example, HQLA and also LCR ratios be below 100%, then it means that your asset and liability mix does not, there is a mismatch, and that mismatch can lead to risks such as liquidity risk, can lead to, for example, interest rate risk, forex risk, talked and seen how banks can hedge or mitigate themselves against such risk, e.g. using swaps, options, futures, and also diversification of their funding sources. Let's also look at another tool that can impact the LM strategy of a bank or a commercial bank in this case. Let's say there is a net stable funding ratio requirement that is imposed by the RMB, the Reserve Bank of Malawi. That means that there is a regulation that commercial banks, you should concentrate, unlike the bank that you talked about in Malawi, should concentrate most of their funding sources on stable funding, and not, for example, sensitivity analysis and stress testing. Then the bank won't able to pay its short-term obligations, okay, as that bank was unable to. So banks should always maintain a stable funding source, for example, in long-term assets, okay, for example, in long-term government bonds and bills, and not short-term debt, and also even debt in general. Okay, and also even they should not concentrate in interbank borrowing. These are short-term borrowing. It led to the collapse of Northern Rock, as we also have treasury bills and bonds. And then, so when you have that, when you have, for example, an ALM strategy that gives into a positive gap, especially in the short-term gap, positive gap, for example, so now the assets are more than the liabilities. For example, you have treasury bills and bonds. Okay, so the NSFR, the net stable funding ratio, maintains that you should have those. You should concentrate most of your stable funding in those. Okay, then that will naturally impact the ALM strategy, and also it will impact the asset liability mix. Now if there is a mismatch, and then it will now dictate which kind of ALM strategy you can use. And you can always, before you can now do some, you can put some measures in place to now rebalance that, to rebalance the mix of your assets and the liabilities. You can do deposit campaigns, you can renegotiate, for example, with your creditors, things like that, right? You can the CBK or RMB in this case requires banks to maintain sufficient capital buffers in cash and cash reserves, and also in T-bills and T-bonds that can easily be, generally in high quality liquid assets that can easily be converted into cash and cash reserves to absorb losses. You know, banks can also make losses, as we saw. So let's say a bank makes losses in the short term. Like for example, you have 100 million, you lend to me. So I'm the bank, you are the customer. Okay, you give me 100,000 Malawian kwa a year. So you want 115,000 after 1 year, right? I, as the bank, will invest, will give out these 100,000 Malawian kwacha in a loan to a customer who maybe wants to do some business or wants to import some and then make some profit. Let's say they'll make 20% profit, and since you can't, as a bank, take all their profit, you'll just demand from them. Let's say, I just want half of that profit margin you made, that is 10%. So you'll have made, as a bank, 10,000 in profit, but you want 15,000 profit, right? So I'll have made a 5,000 loss because I'll have to give it to you. So as a bank, the CBK or the RMB imposes regulations that I should maintain enough capital, short-term obligation, but also even to absorb losses. For example, even in economic downturns, let's say there is an economic downtime, or there is unemployment, inflation, people are unable to service their loan, there is credit risk, you will be able to, because let's say the person I lent to the 100,000, I expect them to return 110,000, but they are unable to do that. You will still need your 115,000. So that's a loss. It may not be a loss in the long run or long term, but right now you want your money, so it's a loss. I should be able to maintain enough capital buffers to be able to absorb that loss. And what does that mean? It will impact on the LM strategy, the asset liability mix management that I will put up in place folder in my book. So banks with weak capital buffers will face, for example, a restriction even, or will pose. They'll face, for example, CBK and RMB. What are they called? Restrictions. Okay. For example, they'll not even be able to access some of the facilities that the RMB that may offer, the central bank may offer, for example, the discount windows, and also the emergency loans. Okay. Even the CBK, even before you are allowed to even pay dividends to your shareholders, you are required to maintain some proper mix of liquidity, right? Yeah. So the CBK may even impose you or restrict you from paying out to your shareholders. And what will you tell your shareholders? Shareholders may become disgruntled, and they can withdraw their shares, and submit your profitability, which is the biggest the biggest functions of the Treasury Department of any bank. or a reserve bank. So I want us to the tools of liquidity management, the LCR, the NSFR, and also the funding strategy, all the funding sources, and also the how to diversify our funding sources. Okay, so let's say you maintain a liquidity ratio of 90%. We said yesterday that the liquidity ratio, as per the not even as per the CBK. CBK maintains that it should be significantly above and enough capital buffers to be able to incur or service your short-term obligations. So, you let's say the bank, for example, or the bank in Malawi or Northern Rock that collapsed, they relied heavily on short-term funding or debt from the interbank markets. Okay, so if you rely too heavily and your LCR in that case is below 100, then you need to hold enough high quality HQLA, high quality liquid assets that should be able to enable you to service your short-term obligations. This can include cash or. And now, how will funding strategy impact, for in an example, impact the ALM strategies that we'll put? Let's say we have liabilities, okay? Let's say borrowings or fixed deposit that customers have saved with us, okay? So as we saw the gap analysis, during the gap analysis, we need to, in the short term, we need to maintain enough capital buffers that can incur or absorb that gap, okay? That gap between the assets that we hold and the liability long term, to absorb any risk that may occur. For example, interest rate risk may impact or may expose, for example, our risk sensitive assets and liabilities. Okay, risk sensitive assets and liabilities. For example, customer deposits are not demanded. Okay, so to do a little bit of not a little bit. We need to do thorough forecasting and monitoring. You remember yesterday we talked about that. From previous, for example, even recent movements, we should be able to do projected cash flows. For example, we should be able to say that around the third quarter of an economy, for example, this and this much cash reserves is needed in the economy in circulation. Therefore, the RMB will, in this case, the Reserve Bank of Malawi will impose requirements onto the commercial banks in Malawi to be able to maintain an asset liability mix that will be able to meet that projected cash flows or forecasted cash flows. Okay, so forecasting and monitoring, you should be able to monitor, for example, cash flow projections, and also monitoring, for example, liquidity needs and management to be able to handle any shocks. And then that's where, after forecasting, then we can do a sensitivity analysis or a scenario analysis, a stress testing, to be able to see in case of shocks in the market, such as market crashes, bank run, and surge in withdrawals, what will we be able to handle that risk? Okay, so yes, is that okay now?
Yes.
Yeah. So in that case, if you, for example, if in that case, if you don't comply with the LCR requirement of the RMB, then one, you are there will be regulatory consequences, right, by the RMB, okay, because you are not complying with the Basel III requirement. And then what you will need to do in that case, you need to increase your capital buffers, for example, in cash and generally high quality liquid assets. Secondly, you need to, if you rely on short-term funding, like the bank, the Northern Rock, which collapsed, and also the bank, if you rely too much on short-term funding, for example, borrowing in the interbank markets, then during, for example, market crashes, you will not be able to meet the NSFR requirements that you should be able to. Your asset and liability mix should compose of stable funding. Okay. And then, so now what should you do as the Treasury department of that bank? then you should consider investing in longer term stable funding, generally stable funding instruments. For example, term deposits, you should do, for example, deposit promotions. Also long-term bonds, things like 10-year bonds. You can diversify also your funding sources, not just concentrate your funding sources on one particular source of funding. And you can also even invest or concentrate your funding sources on different. Okay, we have seen how to manage the different types of risk. In particular instances of ALM mismatches, we looked at an example of for example, an hypothetical release by the release or balance sheet of the, for example, we just took an hypothetical National Bank of Malawi, and then we saw how each risk was able to influence each particular mix. For example, if in the short term there is a higher mix of risk sensitive assets, then it led to, for example, a capital or interest rate gap of negative 50%. So in this case, should there be fluctuations in the currency and also in the interest rates, then we saw how we can hedge ourselves against that.